You hear in the news all the time, capital gain rates are different than regular tax rates, right? For those who watch the news, listen to the news. Unless you're me, who just ignore the news, because it's depressing. What this is, everything that you have has a value. If you sell it, determines if there's a capital gain or not, and is it taxable or not. And I shouldn't just say gain, because there could be losses. Okay? So what this chapter is doing is talking about how to record your transactions on your tax return for things that you sell. The most typical thing you think about when you hear capital gains is what? Stocks. Right? So that's the most common. What are some other things you think?
Real estate.
Real estate?
Bonds.
Bonds? How did we all get here today? How about your car? Believe it or not, some cars are considered capital assets. The normal car is not. But you have people who are collectors, right? And they just love sinking money into that thing. But if they were to sell it, that's a capital asset. I had a gentleman, he bought a car for $3,000, sold it for $6,000. He put $1,000 into it. Okay? So, what are you looking for?
A mouse for him. We took one because.
Yeah, you're fine.
But
Just went to that computer.
I got mouses for you. Mouses for days.
One of these has to work.
Okay, so we were at an audit, and they go, any other income? He goes, no. Oh, well, what's this deposit? Oh, I sold a car.
Oops.
Well, that's income. Oh, well, what did you pay for it? $3,000. Well, you sold it for $6,000. He got caught. And he did that a couple times a year, buying and selling cars, fixing them up, selling them for a profit. You know. What about jewelry? Antiques. Pictures. Collectibles, yeah. So there's a lot of things out there. You just got to open your mind and see. One of the things in here, we can talk about it now, is your personal house. Okay? Your personal house could be taxable. The odds in Buffalo, New York, of the sale of your personal house being taxable is slim to none. Okay? Just so you know, the law changed in May of 1998. People still remember the old law. Okay, so almost 20 years ago, this is what people remember. Okay, and for those who have been around that far and owned houses, you may know it. The old law was, if you sell a house, your personal house, for a gain, how long did you have to buy a new one, sir?
6 months.
6 months? Day.
Oh, it was 2 years.
No, I thought it was
18 months. 18 months to reinvest your gain, or it would be taxable.
A similar, of like value or something, wasn't it?
It had the increased value.
Yeah, increase.
What if you bought the new house for less money than you sold the old house?
Then you pay tax on the gain.
So I broke the law?
Yes, you did. If you did it before 1998.
Yeah.
The new law since May of 1998 is, and this is why I say, rarely in Buffalo will it be put on a tax return. if you sell your house, if you're single, for a profit, not a sale price, a profit of $250,000. If you're married, a profit of $500,000. So see why I say it'll probably never happen in Buffalo?
Yeah, but if you sell multiple, is that?
It's your personal residence. If I live in Buffalo and I have a second home in Florida, my personal residence is in Buffalo. My second home, if I sell it for a profit or a loss, is a taxable transaction on my tax return.
Well, yeah, but there's really not that many houses in Buffalo worth 500. Because there's more houses than people.
Right. But the housing market's going up in Buffalo. It's you know, well, hopefully we'll never see it, because I don't want to see the downfall of it. That's why I say hopefully we'll never see the California, Las Vegas where it's and then it just drops. And then it goes up and then it drops. I don't want to see that. I like our little steady going up the chart.
Well, there's pockets of areas that, yeah.
Yeah, I mean, Buffalo has just, Elmwood Avenue has just gone crazy with value. So it has.
LeBron.
Okay. Yes.
What about on the loss side of that? Is it like any loss? If you
On
sell
your
house for
personal
loss,
residence, loss is not deductible.
No loss at all,
No loss at all.
even if it's a big loss like that.
Even if it's, yep, you could buy a house for $400,000 and sell it for $200,000. The IRS says, sorry, Charlie, you lose.
Just doesn't seem appropriate if you have to pay on a gain. If you're over 250, why would there be reciprocal loss?
Do as I say, not as I do.
Because hopefully you don't buy a house that decreases in value that much.
Well, a lot of people were under the law.
Yeah. Well, around here, not really.
No, but.
And that's the thing, but in general, yes, it does happen.
Certainly does.
But what they did do is, if you were underwater and you let your house go, remember cancellation of debt is income?
Mhm.
Right? Everybody says, oh yes, I remember. Okay, well, if you let your house go, that means you let your mortgage go. What happened? That's a cancellation of debt. That should be taxable. The IRS right now has it, because your house went underwater because of the housing market, that cancellation of debt is not taxable. So they do have a couple things out there to help people. Okay. And the nice thing about your house, your gain, you could, as long as you live in your personal house 2 out of the last 5 years, the gain's tax-free. So I could buy a house, and you know, who watches HGTV? I'll admit it, I do.
Too much.
Yeah, too much. That's normally the case. What are the big shows on HGTV? Flipping, right?
Renovation.
So if I buy a house and I'm gonna fix it up, I can live there for 2 years. So I'll buy it for $70,000, put $100,000 into it. It means my basis is $170,000. Turn around, sell it for $250,000. I make an $80,000 profit. Okay, but I lived there 2 out of the last 5 years. Tax-free income. Buy a new house. Buy it cheap, fix it, make a profit, live there 2 years, tax-free. I can do that every 2 years. So you could basically, if you're good, if you know how to fix a house, you could live like that. If you're good with your money, yes.
But for the most part, you fix a house and you sell it, you got to pay some taxes on it because it's gains.
Not if it's your personal residence.
But if it's not, if you
If
just bought
it's-
it for purpose of flipping it.
If it's your second home, an investment property, yes, and that's what this chapter talks about, is investments.
Question. So what if you have a house up in Buffalo and you have a house down in Allegheny County? What if you lived in both of those houses for 2 out of
Where are you registered to vote?
Oh yeah, I'm not registered to vote here. No, I'm just saying because I have a house here and I have a house in Allegheny
Yeah, it depends what's your primary residence. I mean, that's what they could do, but you could have had a house in Allegheny County for, like, you lived there, then you moved to Buffalo, and it took 2 years to sell that house in Allegheny County. You're still in the 2 out of the 5 years, so that would work.
What happens if you sell a bunch of rental property and you're a single guy
Ha!
and you?
Yeah, we're not
you
getting
sell-
into that right now,
Okay.
because that gets into depreciation. We're not doing that right now. That's another chapter.
Okay.
I'll let my wife teach that one.
Oh, an easy one.
Oh, yes. Okay, so everything has a cost basis. If we turn to 7.4, so we're going to learn first what gets put into the cost. Okay, so we just, so the first thing is easy. It's your purchase price, right? Okay, so now if we're talking about a house, you could add in, what's the next thing after a purchase price, Debbie, be quiet?
Closing costs?
Closing costs. You have to pay closing costs when you buy a house, right? Those closing costs go into the purchase price, into the basis. Debbie's a realtor, that's why I told her to shut up.
And I own a lot of rentals.
Okay. Then it's your improvements.
What about attorney fees?
That's part of your closing costs.
Is that also the settlement of property and school taxes?
That's not closing costs. Those are property taxes.
Those don't count.
Okay.
And that's improvements over all the years that you lived there. As long as you keep the receipts, you can count them all.
Yep.
What if you replace the windows twice?
You can count it.
Both times?
Every
Same
year.
with roof?
Same with the roof.
Holy crap.
But the thing is, how many people save all the receipts?
Yeah.
My mother does on her 50-year-old house. She has every single receipt.
Good for her.
Yeah, I know. It's going to make my life easier one day. But, okay. And then when you're done, when you sell it, what else do you have? More closing costs. So that equals your basis, your adjusted basis.
The taxes you pay when you purchase a house or sell them, are those considered?
What type of taxes?
Well, don't you pay that 3.75% or something it used to be?
The mortgage tax?
I don't know, is that what it is? Yeah.
Yes, that's,
An FTA tax or something.
yeah, but it's not your school tax and your county tax or your city
But
tax.
that other
Those
tax,
the mortgage tax counts.
The fighting of that $350.
Yep, that's part of your closing. So you buy a house for $100,000, costs you $5,000 to close, so now your adjusted basis is $105,000. You put in $30,000 into it, so we got 100, 5, 30. Oops, not 300. Holy cow. Okay, and then to sell it, it's going to cost you another 10. So your adjusted basis is $145,000. So if I sell it for anything more than $145,000, it's a gain. If I sell it for anything under, it's a loss. But it's my personal house, it's really going to do. Okay, but if I'm flipping a house That's what I would look at. Okay. The most common, again, is stocks, right? The nice thing is the IRS made a law change in 2011 that made our lives a lot easier. Brokers, whoever you buy the stock from, have to, if you purchased it after beginning of 2011 forward, have to keep track of your basis. Okay? Prior to that, if they did, they were nice, but they didn't have to. Okay? So trying to find somebody's basis on a stock used to be really hard. And it still could be, because there's people out there that have stock since 1980. It was my great-grandma's, and I just can't go about selling it. So they just hold on to it, you know. Or it was from where my dad worked, and it's sentimental, okay. So we'll pick on Scottrade. Scottrade, right? Everybody know what Scottrade is? The do-it-yourself online account. Okay, $7 per transaction. That buying and selling, that goes into the cost basis. Okay. The hard thing about stocks with cost basis, they issue, remember the 1099 DIVs? What's a 1099 DIV? Dividends. What can you do with your dividends? You can reinvest them. What does that mean? You don't get the money, but what happens? You keep buying and buying and buying of that stock. So someone buys ABC stock, they buy $10,000 worth on August 15th, 08. Okay, and they bought 100 shares. In January, they reinvested their dividends of $500, and they got 5 shares. That's 09. Then in 10, they got another $550 for 5.5 shares. And then in 11, are you getting the picture? So, but then in 2015, they sell 100 out of the 130 shares that they have. That's where the fun part begins. Okay. You have 3 options to figure out the cost basis. First is what's called Fifo. No, it's not a dog's name.
First in, first out.
First in, first out. So you could sit there with a sheet of paper going, okay, the initial shares are sold, then this, and total up to the 130 shares, or 100 shares. Well, if it was only 100, there goes that. Okay. The second option, which even makes it harder, is specific identification. So I could pick and choose, I want this bunch of shares, this bunch of shares, this bunch, and then we'll take the remaining out of the 100. You got to be really good with paperwork to do that. Chris? Yes.
After 2011, if they were keeping track of it, isn't the cost basis whatever the broker would tell you after 2011 and then the stuff prior?
That's the only thing the stockbroker would have.
Right.
Is from that.
From
so they would have to supply this to the cost,
right,
to the broker.
Right.
Okay. The third option is the easiest way. It's the average cost method, okay? And how you start a stock when you sell it, you have to continue it the rest of its life, okay? So the average cost would be we'll keep 2010, their total investment is $11,050. They have 110.5 shares, which should still be $10, $100? $100 a share. I did it easy. Okay, so if he sold 100 shares, his cost basis would be the 10,000. But if this was 12 shares and this was 20 shares, so now he has 132.5. So you take the 132.5 divided by the 11,050 to give you your price per share. Multiply that by your 100 to give you your cost basis for the hundreds.
You can't do last in, first out.
I mean,
I don't know, I know you said
you have to go more.
first in, first
Yeah.
out, but you can't do last in.
Okay. Most brokers do the average cost. Okay. The do-it-yourself people may do it different ways. And they'll come in with a nice binder like this. Here's all my stock trades for this year. Oh, okay. Yeah, I saw that face. That's the same face we have. Okay. I'm trying to think. Now, under div, it says in 7-5, a decrease in basement. If you remember, in basis, not basement. If you remember under dividends, there was a type of dividend that reduces your stock basis. Who remembers what that was? Non-qualifying, that gives you a special tax treatment.
What are they, combined shares, is that what it's called?
Long-term capital gains. Distribution.
What form is this in?
Liquid
Liquidated.
assets.
Liquidation dividends. You're getting your money back. Just trying to remember my high school science. So what that is, you got your liquidating distribution. Instead of them giving you money because they made a profit, they're starting to lose money. They're giving you your money back. So in 2012, they gave you $500, but that's your own money. So your shares stayed the same, but your cost basis went down because you already got some of your money.
Do you have to work out what they tell you though? I mean, whatever the broker told you on his forms is what you have to put in for here, right? You can't change how the dividends get.
Well, hopefully they keep track of that.
Right.
Well, I'm just saying, because the book says reduction of basis, so I'm explaining.
Okay, gotcha.
Okay. Let's see. In property, there's easements. It's where an easement is where the town buys your property, a piece of your property, and you have no say about it. Okay, so say we own a home here on Sheridan. Okay, they want to widen it. They just come in and say, Debbie, here's $20,000 for 15 feet of your lawn. You can't say no. So that 20,000, you get the 20,000, but that reduces your basis of your home by that $20,000.
Is that $20,000 taxable?
No. If it was an investment property, it could be.
Oh, it's only for your primary?
That would be a
Primary
best to figure
tax.
that one out.
You wouldn't be able to fight that, you would have to say yes.
Yes,
Yeah, it's eminent domain.
Yep.
You just got the right to take it and give
they
it.
can do whatever they want with wherever they want. Gotta love the government.
Do they have to offer you money?
I would think they would.
They're
But-
usually fair with like what.
Not to kill you.
No, that's the mob.
They usually give you like a prevailing rate.
Okay. And then there's basically, so we know purchases. There's 3 other ways you can obtain property. Okay. First one is inherited. Mom dies, I get her house. Okay. The value for me for the house is the fair market value at the date of her death. So like I said, she bought it almost 50 years ago for $19,000. Her house now is worth $120,000. So if I got it when she passed away, I don't have to dig through all her receipts. I just get the $120,000.
Do you have to get that back now?
Normally, the normal person who inherits a house sells it right away. Okay. If I hired Debbie to sell my mom's house, hopefully she doesn't say, whatever she's telling me it's worth is what I'm listing it at. And if it's 3 months later, again, we're in Buffalo, it's going to be the same. Okay. On an inherited house, you can take a loss. Okay. So the house is worth $120,000. Okay. I don't want to deal with it. Too many emotions, you know. Somebody comes in and says, I'll give you $100 for it. I can claim the $20,000 loss, plus part of my loss will be the closing costs. So I'll have probably almost a $30,000 loss I get to claim on my tax return.
If you do improvements to that house,
After mom died, then I get to increase the basis.
So is that deductible, those losses?
Okay. Another form of getting property is by a gift. So mom, before she dies, gifts me the house. She turns it over to me in my name, takes her name off before she dies, because she just doesn't want it to go to a nursing home. Okay?
5 years.
There's a 5-year look back, yep.
Plays in the business, I know.
Okay, but not my basis now is mom's basis, so what she bought it for, plus all her improvements. So now I'm going, thank you, Jesus, that she kept track of all her improvements. Yes.
Is that opposite with stocks?
No, same thing. Yep. Any property, an inherited property, it's fair market value at the date of death. A gifted property is their basis, their adjusted basis, I should say. Okay. And then the third way, okay, which hardly gets reported on the tax return, is bartering. I mean, everybody know what bartering is? Not bartending, not a barber where you go to get your hair cut. But
Swapping.
yeah, you're trading. Okay. You're a landscaper. Somebody, someone calls up and they want you to do their landscaping and redo it. You get there and it's about a $40,000 job. And you go, well, instead of paying me the $40,000 cash, I'll take that boat. Okay? That boat's value to you is $40,000. It's still taxable income to the landscaper. Okay. That, believe it or not, bartering is about the third or fourth question in an audit. Have you ever bartered, or do you belong to a bartering club?
There's clubs that.
Mm-hmm.
Yep.
Mm-hmm.
When you barter and you get a product for bartering, do you have to pay Social Security and Medicare,
If you're-
Medicare taxes on the bartered amounts?
If you're in a business, yes.
What if you're an individual?
No.
Do they have to get that boat appraised for what the value of
No,
it
you
is?
agree. By saying it's a $40,000 job, you're agreeing, the guy who's giving the boat is agreeing that boat's worth $40,000.
Even if it's like a $100,000 boat.
You have to pay.
He would be really stupid to give a $100,000 boat for $40,000. But then again, when's the two happiest days of a boat owner's life? When you buy it and you sell it. Okay, but there are a lot of people out there who barter. You know, that's one example. Another one is, I'm a painter, Debbie's a dentist. I go to paint Debbie's house, and she goes, look it, I'll clean your 2 kids' teeth for the next 5 years instead of giving you money. Okay, that's barter. Income and income, we both have to report it.
Never report that?
Yes. We actually had a landscaper we did tax returns for. We did. Because he didn't report his bartering.
On a boat.
On a boat, on a car, on snowmobiles, on ATVs.
Oh my goodness.
But there was no money though. Like, he didn't sell it or anything. He got
It has a value.
Right, but he performed a service to obtain it. So his payment was the boat, was the RV.
So he
Was-
had to
Because if
pay.
he wasn't, he would be getting cash, right?
Right.
So he had to pay whatever the tax would have been on that dollar amount.
But if it was a gift, he wouldn't pay
Right.
tax on it.
Right.
Somebody else have claimed that as a loss?
Well, if that was a business, his services to them would be taxable. Again, upon the agreed upon price.
Right, so would IRS be looking at, like, cross-referencing those tax returns? Like if somebody
They could.
had to, if somebody used their boat as payment, would they then claim that as a capital loss?
Well, a boat's a personal, if it depends, if it's a personal asset, you can't claim losses. If it was a business asset, if he was in the business of renting out boats or doing something, a commercial fisherman.
Okay. So you would have to get their name and social security number
Yeah.
then for whoever you're getting the boat from and vice versa.
Yeah, when you go to DMV, they'll catch that.
I mean, the thing is, how we caught this guy,
Wasn't making any money.
Right.
well, we do his tax return, and when I do a business, whether it's self-employed, corporate, I always go, so how was your year this year? How did you do? Oh, it was good, I made a lot of money, or it was all right. So I know when I'm doing the tax return, how it's looking. And he would always go, oh, it was a great year. Okay. And I'm doing it, and I look, and a loss of $70,000. Great year, and you got a loss of $70,000. To me, that doesn't sound like a great year. You call him up, what's going on? You told me it was, oh, let me look at it. He goes, you know what? My wife double booked an expense. It's really, so then Okay, it's still not a great, and we just said, you know what, we're done. We're not playing this game. Go somewhere else. I mean, because he's writing off every single expense that he did for that $40,000 job, the $10,000 job, the whatever. He's not claiming the income, but he's taking all the expenses off.
Oh, wow.
He can't. But he would have to pay taxes on it as if it was money. So why
Right.
wouldn't he be able to make expenses?
If you claim the income,
Oh, but
You
he
can
wasn't
claim-
trying to claim the income.
he wasn't claiming the income.
But he was trying to write all the
Yes.
stuff off.
You show minuses, no pluses.
You sound very smart.
Okay, let's see. On page 7-6 is a nice chart for examples to adjustments of basis that we talked about. And this is Esther. Hello. Hey, I'm teaching. Yeah. Not really. Okay. Okay, fine.
The question on this casualty loss,
Yep.
I guess I don't understand it because if something happens to your house and the something that happened is a $10,000 job,
Yep.
and the insurance company gives you $10,000 and you fix it.
That's not a casualty loss.
Okay.
A casualty loss is like these homes in Florida and Georgia and North Carolina.
They sink into the ground.
The government, you lost $80,000 damage. And they say, well, I had a hurricane. Well, it wasn't hurricane, it was flooding. We're not going to cover it.
Okay.
Okay? So now you lost that $80,000 and you claimed it on your tax return. By claiming it on your tax return, you reduced your basis.
But that's on the increase to basis on this chart. That's what's confusing me.
Well, that you had a loss.
Yeah.
And now you fixed it. That's a capital improvement.
But
So
only if it's,
read the parentheses. What does it say? Or not, there's no, restoring damaged property. So you're putting money back into your house.
You're making it better than it
but
was
if
before.
if what you got to fix it from the insurance company was the same as what it cost to fix it, that's a wash.
You're
no?
supposed to show the math.
Oh, really? Oh. Seems crazy, but.
Okay. Let's see. Okay. On 7-11 is your 1099-B. Again, the letter tells you broker or barter. Okay, guess how many 1099-Bs I saw for bartering? 0.
Out of all the returns that you do?
Out of all the returns I do, have never seen a figure in there. Okay.
Oh,
This one is a very uncommon form, I can tell you that, for a 1099-B. Okay, normally it goes sale date, purchase date, purchase price, sale price. That's how the normal 1099-B looks. Just a landscape version, nice and simple.
well, it usually has a person's name and social on too,
I
right?
know, but I'm just. Okay, so, but the numbers, again, are still all the same. What you have to do, though, is realize if something is short-term or long-term. Short-term is held 1 year or less. If you sell something in that time frame, you pay your normal tax bracket. So if you're in the 15%, you're paying 15%. You're in the 33%, you're paying 33%. Okay? Long-term means you held it for more than a year. If you did, you get the same tax breaks as your qualifying dividends. So if you're in the 0 to 15%, your tax bracket or your tax on your long-term capital gains is 0. If you're in the 25 to 33, you're paying 15%. And if you're in the highest one, which is like 39, you're paying 20%. So if you're coming close to that year, hold on to that property, that stock, for a couple more days if you can. Get that. I have a client whose investments are muni bonds and stocks. We're talking about $50,000 a year worth of income. She pays no tax because they're all qualified dividends. And what about muni bonds? Tax free. She doesn't work. She just has a lot of investments and she's all tax-free income, or because of the capital. I mean, it's pretty amazing.
So you're saying she gets the dividends, and then she puts it into those things and it
No.
holds them a year?
No, her dividends are qualified dividends. So they qualify for the reduced tax rate.
But you gotta have one hell of a chunk of money to make $50,000.
Oh, she does. She does. Dad was a predominant lawyer in the area. Her father, oh my God, was my client first. And he would come in and I would just input his return. He would type out his tax return before he would give it to me to input it in my computer. This is how the dad was. He called New York State one time and said, "Your tax law is wrong." And they go, "No, it's not." He goes, "Yes, it is." And he explained to the person over the phone. And they go, "Well, you need to write to us and explain it." He showed me it. It was a little bit thicker than your book.
His explanation.
His explanation.
Oh my goodness.
They changed tax law. That's how her father, I mean, he was that good.
Wow.
Hope we got a royalty out of it.
Why do we need you to do taxes then?
Because he wanted me to electronically file them. And then he got older and he just goes, "I don't trust myself anymore." Okay. Let's see, decimal trades, exchanges. On page 7-13, transfers between spouses. Generally, no gain or loss is recognized on a transfer of property from an individual to a spouse. Okay. Related parties. If I were to sell Like I inherited my mom's house, and it's worth $120,000. Now I sell it to my daughter for $70,000. I can't claim that loss, okay, because she's a related person. Ever hear of an arm's length transaction? The IRS has that in tax law too. So if someone comes in and says, oh yeah, I sold my mom's house, I want to claim a loss. Well, who'd you sell it to? Should be your next question. Well, it was, and if they, I would even, if they say, oh, it was my best friend's kid and you I would say no. Because you could, I could see the IRS coming back and saying, you know what, there's a relation there, even though it's not by blood. Especially, I've seen people not shut up in an audit.
Oh, yeah. That's smart.
Yeah. We bring a pad and paper, and there's times we'll just write shut up and show it to the person.
You don't tell them beforehand, like.
Oh, we tell them
But they still, yeah.
yes, no answers. Don't go into an elaborate, and they just go and go and go. I had an audit. This guy was a town historian. Okay. We were there 4 hours the first time.
The first time.
The first time.
And how many of visits were like that?
You know how much stuff we went through the first time? Nothing. Because he had explained his job. And I'm like, shut up. That's not what you want. But I gotta explain no, shut up. And she's even saying, please, I understand. But look here's all my pictures of everything, and here's, just shut up. Yes. Talked about inherited gift. Bad debt, 7-14. You have a legal loan with somebody, meaning there's paperwork, okay? Just having a loan between you and your child, and the child reneges, doesn't mean you can write it off on your tax return. There's no legal note. You have to have a legal note. So if I borrow money from Esther, okay, and I just stop paying it, I'm not going to pay her any more money. She has to try to collect on it. Okay, call me up, write me letters, write me certified letters, go to a lawyer. You have to try. And if nothing works, she then can write it off on her tax return as a bad debt. Okay. Thing to remember though is, if she's writing it off, I have to claim it as income. So she has to send to me a 1099-C, that cancellation of debt form. So bad debt you can write off, but you have to have legal background first to make it a legal debt. And then you have to try. You can't just say, I'm done. If you don't pick up a phone,
Now, Chris, if she were to go ahead and file through the county and went through the clerk's office and filed a judgment and everything, and then let's just say 2 years pass and you're going to start making payments because now you can't get a car loan, she has to declare that.
She now has to declare it as income
Right.
again. Yes.
Can I open the door a little bit, or can we turn down the heat?
Sure. I don't think the heat's even on. We normally don't turn it. It's set at 64, so if you want to.
Maybe it's cold to holler, but I'm dying.
It's taxes, don't worry. Okay. Let's see. I don't want to get into a lot of this stuff. Foreclosures, we talked about, that can be income, but then you can waive it. But if it's a business property, it's totally different.
On
Yep.
page 7-17, at the bottom, I was wondering if you could go over where it says having claimed an exclusion for the sale of a home. I wasn't quite getting that.
Having claimed an exclusion for the sale of a home during the 2-year period ending on the date of the sale of the home, the gain from which the taxpayer now wants to exclude. Okay. I don't know what that means. It doesn't make sense. Why? Having claimed an exclusion for the sale of a home during the 2-year period ending on the date of the sale of the home, the gain from which the taxpayer now wants to exclude.
Before it says it's the automatic disqualifications for excluding
Right,
gain.
so unless they're saying it wasn't the full 2 years, if it's the last day of the 2-year period, that's the only thing I could think of. And that would be poor planning on their part. And I've seen that. Okay. There are, from your home, like say you buy your home and 6 months later, your job says, hey, guess what? We want you to move to California. Okay. Well, you didn't live there 2 years yet. Okay. They're going to take that $250,000 exclusion for single and prorate that based upon the amount of time you live there. So it actually goes by days, but we're going to keep it simple and just do months. So 6 months out of 24 months is what? A quarter. 25% times 250,000, about 62.5. So 62,000, your excludable gain is 62.5. So if you only made $30,000 on that 6 months, God bless you, you wouldn't pay tax on it. Okay. Medical reasons. Maybe you buy this nice colonial. All the bedrooms are upstairs. All of a sudden, you have a heart attack and you can't do the stairs anymore. Not the same thing happens for medical reasons. And then I love this one. Any unforeseen circumstance. Please describe an unforeseen circumstance. Anything and everything, right? You lost your job. A hurricane. Maybe a sex offender moved next door to you and you have 3 girls at home. Right? You can, as long as you can explain an unforeseen circumstance, it qualifies. On 719, and are you Tyler?
Tyler.
I got it right. You're not even in my class. Just see from my wife talking about you.
Oh, the TNT, me and Todd.
Yes.
we included your wife in our TNT group.
I heard.
She was quite happy.
Yes. But on 719, You know how you asked about your house in Allegheny? There you go. This is what the government looks at. Your postal service address, your voter registration card, where you use on your tax returns, what are you looking for? A mouse? Sorry. Okay. Now, on your tax return, to record it, all these sales, okay, if we look, it first goes to a Schedule D, as in David. So that's line 13 of your tax return. So if you guys want to open up a return in front of you. You can do any return, I don't care. So you don't have to start one, just click open a return and pick one.
Capital gains.
Yep, go to your 1040 and go down to line 13. Line 13. Once you So on line 13, you're going to hit F9.
So line 13.
Remember, you don't have to start a new return, just open up. I know I'm helping you.
Yeah, you have like 4 or 5 different forms inside of forms. It drives me nuts. That's the most confusing part.
Line 13. So line 13, F9, you go to your Schedule D. Okay. D is in David.
Schedule D didn't pop up.
On line 13, you hit F9,
I hit F9.
and it should say New Schedule D, page 1.
Oh, here we go. New schedule. Oh, okay, yes.
Okay. So now, your Schedule D is divided into 2 sections, short-term and long-term. Okay? Now, 99% of the time, you're not going to enter anything directly on this form. Okay? So 99% of the time, you are not entering anything on this form. So if you just go down to short term, you can go to line 1A, and you're going to hit F9. No, you're not. Why did my computer not do that? Okay, go to, which one line was that?
Short term.
1B.
totals.
Go to 1B, and you can hit F9. Yeah, in your screen, it should say New 8949, page 1A. So So we want to pull up an 8949, page 1A. Page 1.
Okay. And then
Line 9.
right.
No, line 13. He was missing. Casualty.
What do I just- yeah.
Go down to 1B. One more. But 89. Everybody there? Okay. Now, what does yellow mean?
I'm getting it somewhere else.
It's got to come from somewhere else. So guess what we're going to do? F9. It's a-
We're gonna hit yellow and hit F9?
Go down to line 1 and hit F9.
On the 89.
On the 8949.
You mean where the red is?
Yeah, you can go to the left. Yeah.
And then the regular worksheet on that.
I always like doing it because 8949.
Oh, okay.
I just like showing the pattern.
But now I
Yeah,
Okay.
it's going to.
So now on the 8949, when you hit F9, we're going to do the capital gain worksheet. Debbie, what are you doing, Debbie? It's because you're a mouser. There. And we're going to do a new capital gain worksheet. F9, 8949. Come down here, F9, pull up the capital gain worksheet. Okay. Now,
We bypassed 2 forms, right?
Yep.
Schedule B and we'll do
8949. Both, it's how the program's written, but it will make your life easier. Because in years past, especially when you had someone who bought and sold themselves, you would have to go through their list and go, this one's short term, so I can't enter it here. I have to go, and this one's long, and you would have to separate them. On this worksheet, the computer's going to calculate out for you if it's short term or long term for you. So believe it or not, it does make your life easier.
How does it know the difference though?
because if it's under here or over here.
Because look at column B and column C. What does it say?
D required, D
D is
two.
date acquired and C is date sold.
So it does the math.
And short term is anything.
1 year or
shorter than a
less.
year.
Okay. So now, under description of property, let's just type in ABC. Now you're in another column after you hit enter. Okay. This column is a little bit weird. Okay. There's 6 options for there. A, B, C, D, E, and F. They want to know if you know your alphabet. Okay. A, B, and C are for short term. Okay. A means, and it's right up top on your screen, short-term transactions reported on a 1099-B with the basis reported to the IRS. So that means your broker gave you your 1099-B and it's all filled out. Date bought, date sold, purchase price, sale price. They supplied everything for short term. B is for short-term transactions reported on your 1099-B, but the basis was not reported to the IRS. I don't understand how that can happen when it's by law they have to do that.
Do you ever see anything?
Yeah, so usually we won't be putting B in.
I rarely see a B, but even when the brokerage firm, when they send the 1099s out now, you'll have to look at them and they're categorized. These are category A's. These are category B's. These are category D's or category E's. So they make it easier for you, but I don't understand the B.
Well, wouldn't that be because it's an older one that was?
No, you're short term,
Oh.
right?
Interesting.
So that goes under the 1099 area?
Yep. And then there's C for short-term transactions for which you cannot enter A or B. Well, both A and B means there was a 1099B. A C means there was no 1099B. So you bought that car and you sold it. You're not getting a 1099B. You have to take it upon yourself to record it yourself. Okay? So, or it would be the sale of your mom's house, your inherited house. You know, something, again, an asset you have to report to the government that you don't get a 1099B for.
Well, why the heck didn't they just write that under tax?
Because tax law is only like this thick. Do you want it to go back down to this thick? Okay. D is the same as A, but it's for long term. So something held more than a year where the cost basis was reported. E is when there was no cost basis, so it could be the stock you bought in 2007. Okay? And then there's F, which D and E don't apply. Okay? Now, what you have to remember, when they don't supply a cost basis, okay, it's up to the taxpayer to give you one. They can't go, oh, can you just like try to figure it out for me? No. Do you know like what date you bought it on? No. Well, there's nothing. How did you get this stock? Oh, when my Aunt Millie died. I inherited it. Okay. When did Aunt Millie die? I don't know. You got a phone? Yeah. Was it your mom's sister? Yes. Call your mom. Find out when Aunt Millie died. Because online, you can go to, there's many different sites. One of the ones I use is bigcharts.com. Okay? There, you can get, if they don't know the symbol, you can look it up by name and get the symbol, but then you can do a historical quote by date. So at least they go, oh, it was, mom goes, oh, Aunt Millie died April 3rd, 1992. Okay, well now you know a date. So now I can go to BigCharts, plug in ABC on that date, and it will tell me what it closed at that date. And that's what I'll use. Okay. But if he goes, oh, well, my mom doesn't know, and I don't know. Okay, well, you sold the stock for $15,000, and now we have to put no cost basis. So now instead of getting back $2,000, you owe $2,000. Well, wait a minute. That's not right.
That's who they'll find out when Aunt Sally dies.
And all it takes is a phone call. Hey, I got that figure. Okay, what is it? Oh, my cost basis was $12,000. Okay, you plug it in, but you put a note in the computer. Taxpayer called on such and such date at such and such time, told me cost basis of this stock was X amount of dollars. You're covering your ass.
You put it on the worksheet for the extra $2 for us.
Okay. So it's up to them to give you the cost basis. You cannot just do it. You'll also see in F and G are related. Okay. An adjustment to gain or loss that you have to reflect because it wasn't right on that 1099B. The most common one that you will see, that the only one I'm teaching, is a W. And that's for wash sales. Doesn't mean you own a pet company and you go around baiting people's dogs. Okay? A wash sale for stock means you bought ABC stock for $1,000. You sold it for $500. What does that mean? You lost money. If I were to buy that stock back again within 30 days, my $500 loss washes away. It doesn't count. Okay? It's a punishment for buying that same stock back. So this is where a lot of day traders get in trouble. Okay? What's the proper term I want to use? Get addicted to a stock. Okay? Keep picking on ABC. Well, I bought it for $10 a share. I thought it was going to go up. But it dropped to $8 a share, so I sold it. Now it's only worth $6 a share, but I know it's going to come back, so I'm going to buy it for $6 a share. Now it went down to $5. I'm selling it. Now it's down to $3, but I'm going to buy it back. It's going to come back. They take this stock till it becomes worthless. They get addicted to it. It's got to come back. It's got to come back. It's like putting the quarters into that slot machine. I'm going to hit that jackpot. No, I'm going to hit it this time. I'm going to hit it this time. I'm going to hit it this time. That's what they do with these stocks. Okay? So the government said, fine, you can buy them back, but we're not going to let you take that loss until you either don't have that stock anymore for more than 30 days, okay? Or you finally held on to it and you're not selling it for more than 30 days. So all those losses that you weren't able to claim, adjust your basis of that new stock. So we got that one, we bought for $1,000, sold it for $500, so we have a $500 loss. Can't claim it. The next time we buy the stock back, we buy it for $300. So what we're able to do is say, instead of $300, we add that $500 unallowed loss. So now that stock has a basis of $800. So it's not totally gone. You have to wait until it's no more of a wash.
So really, they're spending more money back then.
Oh yeah. Oh yeah. And I know, I can see from my experience, day traders rarely make money. There are the exceptions, you know, the people who hold the seminars. But where do they make their money from? The seminars.
Or the book.
You know, yes.
I also did once, like for a whole year, and I did about 6 transactions a day. The person who did my taxes, she hated me, but I don't know why. Did she have to enter in every single?
In the old days, you used to have to enter every single transaction. Notice old days.
Okay, because this was in like 2012.
Yeah. Well, now what the IRS says, like if you're with Fidelity or even a Scottrade, okay, the 1099B comes in these categories, A, B, C, D, E, and F. So I can just do Scottrade A, put in the dates, and then total sales, because it will have the total sales, $350,000. Purchase price, $349,100. So I don't have to enter the 1,000 trades that equal that up. All I have to do is enter that category. But you have to be careful, because remember, category B and category E are what? No basis is reported, right? So if I'm just looking and I do E and I do sale price 500,000, cost basis 400,000. I could be making a huge mistake, because inside there could be a stock that the person sold for $150,000, but it has no cost basis. So you got to look through those and say, now wait a minute, what about this IBM stock? What's your cost basis? What? It's not in here. Oh, let me do my homework. I have it at home. I can call you back with, and you can add it. Okay? But you got to be careful.
Chris?
Yep.
When I was going through the example in chapter 7, when they were saying that there's a $9 commission on each trade plus $2 sale fee on each sale, I was taking that as an adjustment under column G.
I just put it in cost basis.
So
Normally,
Are you on 722?
I'm looking at 7-37.
Okay.
normally, they're already calculated in on the cost basis.
So column G.
Well, when on that form, the 1099B, if there's a cost basis,
They're already rolling it in.
they're already rolling it in into the cost basis.
So you don't have to come up
So
with-
you don't have to sit there and
figure it out.
figure it out.
Well, they didn't, for one of them, they didn't have the cost basis in.
Yeah.
But they gave the information above.
Yeah, so then you would add,
You would subtract that off the proceeds.
no, add it to the cost basis.
If you add it to the cost, you're gonna deduct it from the sale.
It works out the same, but I gotta tell you,
Yeah.
all the IRS looks at is sales price. If they have reports, and remember, whatever you get in the mail, they get in the mail. So they get this 1099B under you, and it says total sales, $300,000. You report $299,700 because you backed off the transaction fees off the sale price. In a year and a half, I guarantee it, you will get a letter saying, thank you, you filed your return, but you made a mistake. You owe us $100,000 because you didn't report your stock sales. Because it didn't match. They don't look and say, 300,000, 299. Oh, it must be the same thing. They just look to see if it matches. And if it doesn't, it generates a letter on all the sales.
So I have a question for you. I know absolutely nothing about stocks. Now, do I need to?
That's a good thing. Don't start investing.
Well, no, I don't want to go and invest anything. That's why I know absolutely nothing about it. But do I need to go and learn something about it to be able to understand the stuff
No.
that people bring in?
No.
They'll pretty much tell you, right?
If they're an investor, they'll tell you. Okay. So this form, I mean, it's really simple. If we go back and we did ABC, you can put in an A. Date acquired, 10/15/2015. Date sold, 12/20/2015. Sale price, 1,000. Cost base is 1,200. You will see and calculated out in column H, a loss of 200, plus in the S/L for short or loss, long term, it says short term. It calculated out short term.
Why does it say invalid C3 answer?
Probably entered the wrong thing.
I don't know, it says date. Oh, that's the date sold, I don't want
Yes.
to do that. I want the sales price.
No, but you gotta enter the dates too.
Oh. Okay.
Yeah.
Okay.
Well, when we get the statements from State Trade, Scott Trade, the cost or the other basis, that already has the commissions and stuff in it.
Correct.
F9?
So if you hit F10 to go backwards, you will see that it's there on that 8949 for you. And then F10 again, under short term, that sale is there. Okay, now, this is a part I love the government for, ha ha ha.
So, Chris, real quick though, so you're saying that when it's a positive or a negative, that you'll get the letter from like in another year and a half from now?
If that sale price does not match, you will get a letter.
So they will get a letter, if this was a legit
Yeah,
return,
yeah.
they would get a letter.
If they were supposed to have $2,000 worth of stock sales and there's only 1,000, they'll get a letter.
Would you put something in the notes, like when you did this return, so that like in a year and a half from now, like knowing that they're gonna get a letter? I mean, do you even tell the client?
No, because if they give you everything, you're basing it upon what they're giving you. If they don't give you their Merrill Lynch statement and you say any other things, no. There's nothing to worry about. Okay. Now, okay, one of the things, the government, this is really nice of them, you can make $100,000. The government's going to tax you on $100,000 in capital. You can make $1 million. They're going to tax you on $1 million. Get the picture? Whatever you make, they're going to tax you on it. You lose $20,000. If that's your bottom line, they let you claim $3,000. The rest carries forward to next year. So make as much as you want, we'll tax the heck out of you. Lose as much as you want, we're only giving you a baby carrot.
But you can carry that forward forever.
Forever and ever. I have a lot of people who are going to die with losses carried forward. So now, me and my wife, we filed joint. My investments are mine, not in a joint account. Okay? I have a $150,000 loss being carried forward year after year. I die. That year I die, my wife gets to claim that loss because we're still filing joint. The next year, that loss is gone. She has all the stock still, but she lost the losses carried forward.
We only give you 3,000 a year.
3,000 a year.
While you're sorry.
It doesn't matter how much.
Doesn't matter how much you lost.
Until
It's used up. And it says, so this year I lost $50,000. I can claim $3,000 on my tax return. I carried $47,000 to next year. I had a good year. I netted $30,000 gain. My $47,000 loss will eat up that $30,000 gain. So now I have $17,000 left. I claim $3,000 for this year as a loss, and now I have 14,000 carrying to the next year.
So you do get to take off the
Pluses.
amount that you gained this year.
Yes. Your gains will always eat away the losses.
So it can be more than 3,000.
Well, your bottom line on your Schedule D for losses can only be $3,000
How long has it been like that for?
ever in the day.
And it's never gonna change?
Never gonna change.
But if wouldn't she inherit those, and
She-
now it would be under her name?
Right, but the loss,
But before that, because it was under your name
Yeah.
strictly, it's only for you.
Can you, like, say since it's your wife's spouse, because that spousal thing, like that one thing it says, like for your house, if you transfer it, you transfer it to her, and then she gets all the write-offs?
well, the loss dies when I die.
Because it's only in your name, right? But if it was in joint,
If it was a joint account, then she would get it.
Keep the
Yep.
loss.
You can't, like, bequeath it to her or
Nope.
say here. No.
Nice try.
so you should change it to your joint. You should change it to both of you.
If you know when you're gonna die.
Well, can you change it to
You
a
would do-
joint account even after the loss? Like, say you
Yeah.
got a loss of
Yeah.
50,000
Yeah.
in 2014, and then in 2015 you change it to a joint account,
Yes.
and then you die, then she would still be able to take that loss?
Yeah.
Even after it's.
You looking for Rena?
Yeah.
There's no Rena here, right? Do you want it or should I leave it here?
No, it's still downloading until this spot.
Okay.
Gotta hook it up.
Yeah. I mean, it's an unfortunate thing, but gotta remember too, what happens to the wife's basis that she gets all these stocks?
At the reduced level.
No.
It goes back to the original.
No. You get the basis it's an inherited thing, so it goes to the date of death.
I was just thinking that.
So if I had Apple stock that I bought for $100 and now it's worth $300, first of all, I was stupid. I should have kept selling it because I had all this loss that I could have used to offset it, but I didn't. Her value now, because I died, is $350. She sells it for $350. She has no gain or loss.
And a joint account?
No, if it was just in my name. Now, you opened your mouth, you're gonna be sorry. She said, what if it was a joint account? What does that mean? What does a joint account mean?
They both share it.
You both own it. You're 50-50. So if there's $200,000 in there, 100 and 100. Okay? If I were to die when this is our cost basis. Now I die and it's worth $350,000. My wife's cost basis on her half is still $100,000, right? On my half, she gets the stepped up, so $350, $175. So her total cost basis is now, after I die, $275,000. Tell that to a broker. They don't like cost basis. Okay, but that's technically, then you have to go through and go, okay, we have Apple stock. 50% of this stock was mine, 50% was his. So this was my cost basis. Now I have to add 50% of what it was worth of when he died over here. Now we got IBM, and keep doing the same thing. Oh, yes.
And who has to do that?
Well, if you want to do it right, if you're the surviving spouse, you call, then you figure it out, or you sit down with your broker, but make sure they put it in their computer. The most common thing for that, and this is my lovely drawing, is a house. Okay? And this is actually what I do with my clients. Because you will have somebody come in and they'll go, oh, I sold my mom's house or my parents' house. Okay. How did your name get on it? What did you mean? Did you inherit the house? Did mom and dad put your name on the house before they died? Or did mom and dad do a life estate? Okay? Each one of those have different things. If you inherited the house, what's your basis? Fair market value, date of death. If they put your name on the house, they changed it over before they died, what's your basis?
Their cost plus all their investments in it.
Their adjusted basis. Okay, now a life estate, okay, what a life estate is an asset protection. Okay, you're putting a bubble around the house. Okay, the main reason you're doing it is to protect the house from a nursing home. That's why people do life estates. So here's mom and dad's house. Okay, here's the bubble. Okay, so the nursing home, if it's after 5 years, nothing can penetrate it. They can shoot arrows, they can shoot guns, cannonballs, whatever. Nothing can penetrate the bubble. Okay? The thing is, mom and dad put your name on the house, basically. What they're doing is avoiding probate. So instead of listing it in the will that you get the house, and then how long does probate take? It could take 6 months. If you have an ass of a sibling, it could take 3 years. Okay? What a life estate does, it gets rid of that, and it automatically goes to you. You get the stepped up value at the date of death. Okay? But that's the life estate. Now,
Now, if that, it would be similar if it's in a trust, correct?
as long as it's in an irrevocable trust. Yes.
Suppose it was in a life estate, but then it got sold.
With mom alive or dead, it gets recorded under mom and dad. Mom and dad control the house. They have the rights to that house. You can't kick them out. Okay? They have the right to that house. They control it. They do.
In terms of the income, in terms of reporting the income.
It goes on mom and dad's return. Yep. But the thing is, they sell that house, that 5 years starts all over again. That they were trying to avoid the nursing home. It percentages out every year, but it mainly goes on mom and dad's return. Some people try to get smart because if it goes on to the kids' name, they didn't inherit it, they're still alive, right? Mom and dad, that's a gift. So then their basis comes down here. So what they'll do is go, Mom, Dad, revoke your life estate, because then when you sell it, the profit's tax-free. Okay, nobody pays taxes. That's great. Win-win. 5-year period. Starts over again. So you got to be careful. Now, mom and dad's house. I'll pick on my mom. $19,000. Okay, split it between the two of them. $9,500. She could have bought it for an even 20. Come on. Okay. During the time period when my mom and dad were alive, they put $50,000 into it. That means 25 for mom, 25 for dad. So now we got 5, 34, 5 apiece. Dad passes away 6 years ago. Okay. What does that mean for mom? She inherits his half of the house. Okay, and this is the part I do for people. Okay, when Dad died, the house was worth $110,000. So that means this 34.5 now becomes 55.5. Add that to the 34.5, and you got a total of 90,000. Wow, I did that good. $90,000. So if mom, when dad died, decided to gift me the house to protect it instead of the life estate, my value in the house is $90,000 instead of $69,000. So you got to play with the numbers and see. The hard part is coming up with the improvements. Okay? Most people don't save their receipts. And if they did, they don't tell their kids where they are.
Do you actually have to have the receipt though? I mean, if you know that your roof cost you, $8,000, do you have to have an extra physical receipt for all this?
Am I being recorded? Technically, yes, but I can tell you this. I have never, in my 25 years of doing taxes, have seen an audit on a Schedule D.
Well, wouldn't that show up in their depreciation
Not
on
if
their
it's a
taxes?
personal house, there's no depreciation.
They wouldn't write that off like as a capital improvement? No.
Can't write it off on a personal house. Don't confuse it with your rental property. I'll sit down with people and I'll go, did mom and dad do any roofs? The house is 50 years old. There has to be at least one roof. Yeah, that's right. Okay, so, yeah, that was about in the 80s. So what, $8,000? Okay. What about, did they ever remodel the bathroom? Did they remodel the kitchen? Did they put in new carpeting, new flooring? Did they remodel the bathroom, put in a finished basement? Did they, oh yeah, they did this, and we'll come up with some figure.
It's reasonable.
Yeah. $100,000 for a finished basement. It's made out of gold. Okay.
If you don't have firm receipts for those, and you get an audit, are you gonna lose?
Yeah.
Okay.
Yeah, but if you went to a quality roofer, you could always go back and just say you need a copy of a receipt.
If they're still in business.
Right.
If you itemize, you can take the tax that you paid off of.
Now, but back then.
Okay.